Okay, our next speaker is Dr. Ganggang Xu, and Dr. Xu, he's an assistant professor of the Department of Management Science in the Miami Herbert Business School. Dr. Xu received his doctoral degree in statistics from Texas A&M University. His main research interests are non- and semi-parametric regression, functional data analysis, spatial statistics, post-model selection inference, model selection, and model averaging. So today he's going to talk about his recent work on semi-parametric learning of structured temporal point processing. Okay, welcome.
We could not hear you.
Okay. Hello? Can you hear?
Yes, we can hear you now.
Yes.
Yes.
Okay. I'm very nervous. So I want to thank Dr. Wang for his invitation and for Dr. Guang for his warm introductions. And today I want to share with you one of my recent works with my colleagues at the University of Miami. It's called the semi-parametric learning of temporal point processes. So it's a bit different from the topics of the previous two speakers. And so I'm gonna introduce a little bit of background on what is the motivating data set we're having here. So for this project, we're motivated by a particular data sets we obtained from China, which consists of trading activities from around 300,000 investor accounts from stock brokerage in China. And this particular company have 98 brokerage branches, like they're distributed over 25 provinces in China. Most of them are concentrated on East Coast of China, but there are also scarce locations at different parts of China. The reason we're interested in this data set is because this data set covers an interesting time period where the stock market in China, or as a matter of fact, all around the world, experiences some major changes during that time period. So it's from 2007 to 2009, and everybody knows in 2008, the financial bubble bursts from Wall Street, and the entire world was shocked by that financial disaster. And here you can see a plot which is a simple plot for the stock indexes from Shanghai Stock Exchange in that period of time. So in this plot, you can see three time periods. That's a governmental intervention of the stock market. That's on May 30th, 2007. The government tripled the transaction tax on trades. That means the buying or selling stocks. It's to cool down the already heated stock market. And then, but they didn't work very well, and the stock market keeps rising until October 2017, and the Shanghai Stock Exchange reaches a historical high of 6,000 points. And then something happened. Well, we suspect it's the bubble that finally bursts, but more rigorous studies are of interest in financial industry. But that's not the purpose of this study. But when the time moving forward, the stock markets keeps declining, and until in September 2008, the government decided to abolishing the tax on buying stocks. So basically, the government is encouraging you to buy stocks at that time period. And then it actually worked after a while, and then the stock market slowly recovered. So this is the general background of these data sets. So the data we're having are the trading times for the 300,000 accounts during this around 3-year period. So here we randomly pick 10 trading activities from 10 investors, and you can see the trading frequencies are quite different from one investor to another investor. So those, for example, this one, it looks like institutional trader because it trades all the time very evenly across the time period. But this is more like an individual trader. It doesn't make a lot of trades for a very long time, but at the end of this time period, he's just started to trade more frequently than he previously did. So, and you can see many other patterns for these 10 investors. So we're interested in studying what causes such differences in their trading frequencies, especially the intraday trading frequencies, meaning, in a particular trading day, how are the tradings going? So the particular tool we're going to use to measure this type of trading activities is that we use the intensity functions. Essentially, it's very close to the density function, which measures how frequent at a particular instantaneous time point that how frequent the trading should be. Right? So here are the summaries of the general trading activities. This one is the overall trading intensity, meaning it's basically the average trading intensity per account per day from that period of time. So you can find some interesting patterns here. So as you can see, most of people trade at the opening of the stock market, which I don't know why. I'm not a very good finance student. And the second peak of the trading is end of the trading day. And you can somehow observe a valley in the middle of the trading day. So a little bit of a background information here. In the Chinese stock trading market, there is a 1 hour, I think 2 hour break period at the noon. So many people at this time are probably at lunch or go out for a break or something. So the trading activities are relatively low. So this is sort of expected. And if you look at the second graph, it's the trading intensity for 10,000 different accounts. And the main message I want to deliver here is that there are very much difference between these different accounts. For example, as I said, there is a valley in the general trading activities, but you can clearly see some peaks in the middle of the day. So this is an interesting observation because that means as at least a proportion of the investors, they're trading against the general trends in here. But if you look at the others, and there are also many peaks around the morning, the opening of the market and the closing of the market. So the main message here is that you can observe a vast variations across different accounts in terms of a trading activity within a particular trading day. And the third graph shows you the overall stock market situation. So in a particular day, what is the overall trading activities on the market? There are around 662 trading days in our study period, but you can also see there is a great amount of variations across different trading days. This is understandable because if you think about it, there is in finance theory, there is this Monday effects and the Friday effects when people tend to trade more. And there are also holiday effects, and there are also governmental interventions during different days of years. So there are also variations across different days. And we are trying to capture those variations using a simple model. So the tool we're going to use is called a multi-level functional principal component analysis, which is a widely used method in functional data analysis. But the particular challenge in our situation here is we actually don't have a function. All we have are those points at different time points, but there is no response variable at particular time points observed. So this imposes additional challenge for functional data analysis. And this is what we're going to trying to fix. So the model we're using is this we use to illustrate our method. The method is a much more general framework. So our assumption is that we assume a particular the trading intensity for a particular person at a particular day has such a decompositions. So the first part, the X part, represents the account level variations. That means it is driven by personal level characteristics. Some people tend to trade more and buy more or sell more. Some people are more calm, risk-averse people who don't trade very frequently. And there is a second part is the day level variations, which takes care of the market conditions, such as the macroeconomic conditions and policy interventions from the governments. And the ZIJ, which is different from every day, every person, and it's considered as a functional process that has not been accounted by the previous two factors. So basically, it's a very simple model. We assume all the components are independent and they're random. So all the intensity function for a particular person at a particular day are random functions, right? And we're trying to model the connections or try to put some structures on these functions, random functions. And we have our method have three key features. From a model complexity level, we have multi-level. That means we can take care of multi-source of variations in our model, and it is functional. And that means we can not only summarize the trading frequency per day per investors, but we're also able to look at the actual trading patterns intraday, which is much less studied in the finance literature. And we have this financial component analysis, which basically provides your very useful summary statistics for the trading activities for different person at different day. So we'll talk about this later. But the main challenge here, so as I said, the functional principal components analysis are well-established method in the literature, but the main challenge we have here is all those functions are not observed. All we have are just one set of points for each person at different days, and we need to take care of this. And in this presentation, we're just going to use the modeling of the first account level functions to illustrate our idea. So why multiple level model? So actually, point process literature has a lot of models to model such trading activity data. For example, a simple strategy will be, so for a particular accounts, I'm gonna tape all those trading days together as a more gigantic trading history from day 1 to day 662. And then we can use models such as Hawkey's process to model this type of data. A Hawkey's process is basically a self-exciting process. A good example is that the one day you eat a chocolate and it's so delicious you can't stop eating, and you kept eating more and more. And then after maybe 20 tries and you stop and wait for a few days and to do that again. So this type of model is very useful because it is reasonable for many examples, but it is not reasonable here because the trading activity is not only self-exciting. It is also affected by many other factors, such as the macroeconomical situation in any particular day. So so if you are using Hawkins process, it's problematic in the model itself, right? We will be missing a lot of source of variations in the data. And so another problem with such methodology is, so those trading days, they are not actually continuous because there are weekends when there is no trade involved at all. And so the stock market opens at 9 o'clock and closes at 3 o'clock. So after 3 o'clock, there's no trading activity at all. So so when you try to tape different trading days together, it's sort of itself problematic, right? It's not a continuous time process. So the basic methodology we're using here is still the famous KL decomposition. So we can decompose the covariance kernel of the Gaussian process into infinite summation of eigenvalues and eigenfunctions, and then the random function then can be represented as a linear combination of the eigenfunctions, where this coefficients are random coefficients follows some normal distribution. Those are referred to as principal component scores. And these principal component scores are pretty much the summary of different aspects of the functional process xt. So for example, if you just add all the trading times in a day, then the summary statistic becomes the daily trading frequency for a particular user. But no, that's when you have a very special constant eigenfunction. But we might also end up with a different eigenfunctions, and which might provide more angles to looking at this same function, right? So so estimating the principal scores is of major interest in this project. And then, well, I don't have to emphasize enough about the usefulness of the principal scores. And let's see how can we get to there. So this is the major steps we will take to estimate the principal scores. The first, we're gonna take care of the covariance function estimations. And then we're gonna move on to estimate the eigenfunctions and eigenvalues. And with the eigenfunctions and eigenvalues, we'll be able to predict the functional principles for each account and for each particular day. So I don't want to get into too much technical details about how to estimate this, but the general idea is that we want to study the correlation between the trading times for any two pairs of event times. So that is, if you take two functions, and these functions, they are random functions, so they're at particular s and t time points, they are random variables, and we're going to look at the correlations or cross moments between different trading intensities. For example, the first one is the correlation between 2 time points from the same day in the same accounts. And then because of our model structure, it will consist of 3 covariance kernels adding together. And then if we consider pairs of time points from the same person but different days, and then it would also involve covariance kernel at the account level. This is just because we assume the yj's at different days, they are independent of each other, but this independence assumption can be relaxed in a sort of relaxed. And if we consider pair of trading times from the different accounts, but at the same day, and then the results would only involve the first, the day level covariance kernel. And then lastly, if we compare a pair of time from different time and different day, and this becomes just the multiple of the first order intensities, which does not involve any covariance kernel at all. So just by looking at this expression, you would somehow see, if I take a ratio of these two guys, I would get a ROI. If I take a ratio of these two guys, and then I can get Rx, and then after taking care of Rx and Ry, the Rz is naturally obtained by taking other ratios, right? By plugging the estimates for Rx and Ry. So that's the major motivation for the estimation. And this is how to get the data version of expectation of this. And basically what we did is we consider all pairs of time points from the same date, same objects, and we use a kernel function to do a local kernel estimations. And we can show that if I take expectation of this guy, it will end up with this thing we have considered here. So on so forth, if we add all the pairs from the same person, different days together, we got B and C and D, right? And then the ratios of them will give you the estimates for the covariance kernel. So the idea is very simple. And after you get the covariance kernel, and then we can use the classic methods to get the eigenfunctions and eigenvalues, right? So finally, after you find eigenfunction and eigenvalues, in principle, it should be very simple to find the principal component scores, because by definition, it is just a projection of the original random function on this eigendirection. But the issue is that we actually don't observe xt, and we don't know xt at all, right? So this methodology in the functional data analysis does not apply here, simply because we don't observe the latent function. So instead, what we propose to do is a composite likelihood approach. So what we did is, so here I'm going to aggregate all the trading times from different days for the same account all together, which become a bigger point process. And then I'm going to aggregate all the other trading times as another group of time points, which becomes another time points. And then we calculate the probability of, so say you observed an event at time t. What is the probability that is from account I, right? Then, so after some straightforward, I say straightforward because it's kind of tedious, and then the final result is like this. So it's actually the probability of that is of such form, so which is actually a function of the principal scores. And then we can estimate the principal scores by maximizing the binomial likelihood like this. So in here, it's all the time point that is observed at account I, and this is the multiplication of all the time points that are not occurred for account I. Right? So these are the very straightforward extensions of binomial likelihood. A couple of things I want to highlight here is that in the traditional principal component analysis, the principal scores, they can be estimated one by one sequentially, right? But in our case, we cannot do this. The reason is, again, this formula does not work. So we have to estimate the bunch of principal component scores all together, right? And simultaneously. So to establish the consistency results is a bit more challenging than the classical case. And another complication from this data set is that when you talk about stock trading, there are two types of stock trading. One is buying stocks and the other one is selling stocks, right? So we want to look at the buying process and selling process differently, separately. And then we can model them separately, but it is also interesting for finance people to see, so whether there are any correlations between, for a particular day or for a particular account, whether there is any associations between their buying activities and selling activities, right? And it is useful for like behavioral finance people to characterize investor behaviors at different stock market conditions. So we can also do that using our proposed model. We just give each process a different model and then try to connect them through the assumption that the principal component scores, because individually principal component scores, they are normally distributed. So if we can introduce correlation between principal component scores, two sets of principal component scores for the buying process and for the selling process, and impose some correlation structure between them, we can somehow correlate the buying process and selling process altogether, right? And then we're not going to propose a parametric model for the correlation. Rather, we just estimate the correlations between our previously estimated principal component scores. And so the way we do it is as following. So we just consider the cross-covariance functions between the buying process and the selling process. And then mathematically, you can show that the correlation matrix between two sets of principal components can be estimated using this formula. So if you look at this formula for the correlation matrix, we already estimated the principal component, the eigenfunctions, and here are the eigenfunctions for the selling process. As long as we can estimate the cross-covariance functions, we should be able to estimate the correlation matrix between the principal component scores, right? So the idea is very straightforward, and we can consider similar pairs, but now we consider pairs from different process. So across different process, for example, this is the intensity function for buying, and the second part is the intensity function for selling. And then we just, using our previous strategy, again, we compare pairs of times from different accounts at different days and so on and so forth, and we should be able to estimate Q function. And then when this cross-covariance function is estimated, we just plug in this estimates into this double integrals to find the covariance functions between two sets of principal component scores. And then by looking at the correlation coefficients, and then we somehow can establish some associations between the buying process and the selling process at different levels. Right? So without further ado, let's go back to our, well, I'd like to show you some simulation results, but everybody knows simulation always work. And so I'm just gonna skip the simulation and go to the application directly. So recall that we estimate this is the latent Gaussian process at account level, and which can be represented by the linear combination of the eigenfunctions. And the first issue we need to address is how many eigenfunctions do we want to approximate our latent Gaussian process at the account level. And so we just follow the general principal components analysis. We just look at the eigenvalues, and this is accumulated variance at PX principal components, and we look at the percentage of variations explained by this PX many principal components, right? And it turns out in our data set, the first three principal components at the account level takes account about 96% variations, and at the day level also takes about 93.4% variations. At the account and day level, things becomes more complicated because we don't have enough replicates to estimate the principal component scores anyway. So we're gonna we're going to just pretty much ignore this. But this also tells you like how well the model approximates the data, right? So let's first focus on the account level. And these are the estimated eigenfunctions at 3 levels. This is account level. The first row is account level, then this is day level, and the bottom row is the account and day level. Let's focus on the first two. And one observation is that the first principal component, the first eigenfunction are horizontal line. So what it means is when you calculate the first principal component, you're just adding all the intensities together. So sort of like just adding all the transactions in a day together. So it's an overall trading intensity for a given trading day at the account level and at the day level. And the second principle, a second eigenfunction at the account level is actually a linear function, decreasing linear function. So the interpretation of this second principal component would be, well, roughly speaking, it's your morning trading intensity minus the closing trading intensity. So how your trading intensity increases over time. So if you have a high positive score for the second principal component at the account level, that pretty much means you really like to trade in the morning, but hate to trade at the end of the stock trading day. If you got a very large negative score at this second level, that means you are like an afternoon person instead of a morning trading person. So this is another dimension of the trading activities in addition to the overall trading frequency at the account level. If you look at the third eigenfunction, so it's pretty much 0 in the morning, and this is the opening time at the noon, and this is the closing in trading. So the third principal components pretty much tells you how your trading activities decrease in the afternoon. So if you have a high positive score at the third level, that means you really like to trade in the noon instead of at the end of the trading day. So we've seen some examples in our intensity functions. As you've seen previously, there are a bunch of people who has a high peak trading intensity at the noon, right? This is pretty much reflecting those people. As a day level, so things is a little different. So the second principal component at day level is just a morning trading activity, roughly speaking. And the third one at the day level is pretty much the noon trading intensity, right, of the market, not at any particular time point accounts. So we could also use one of the objective of doing this principal component analysis is to identify some very strange trading activity accounts, right? And these accounts are very troublemakers in the stock market, and we want to pick them up one by one. So what we did here is a very simple exercise. We just put the principal components account scores at the first direction, which is overall trading activity, right, for accounts at the day. And this is the second principal component. And this is also the first principal component and the third principal component. So what we can see here is if you look at here, there is just very little variations around here. So this means when you receive the high score in the first principal component, your variation across the second and the third principal components are very small. That is to say, if you have relatively higher trading frequency, then that means you're more likely to trade evenly across the day, right? And if you received a very low score, that means for those people who actually trade less frequently, they're very different. They're very diverse groups of people, and we really need to look at them differently from other angles. Maybe you cannot just look at the overall trading activities to tell whether they are abnormal investors at particular points. So this is a very simple study. We haven't got into very much detail of this data set yet, but this somehow shows that our model can somehow pick up some characteristics in addition to the overall trading activity for a particular account. Now let's look at the day level principal scores, and you can see this is the 662 days over the 3-year period of time. And if you look at the first principal component, and which is again the overall trading intensity on the market, right? And as I said, there are 3 key dates which happens when the government do something about that. And you can see the first one is when the government increase the tax on a stock exchange, and you can see instantaneously the overall trading activity goes down. And this is the when I forgot when this is about, when this is the stock market reaches all-time high. So for the first principal component, this is not very meaningful because you cannot observe many big trends around here. And also, and this is when the government abolished the buy-in tax. So, and you can see some sort of a delaying effect in terms of the overall trading activities. And then we can take a look at the second principal component scores, and which is somehow can better pick out those policy interventions, effects of the policy interventions. So these are the morning trading activities for the investors at a particular day. Another special case about Chinese stock change is there is a 10% increase limit for any stocks, right? So if you look at here, when the government abolished the buy-in tax, so what happened here is that so people, after the policy is effective, then people just buy stocks like crazy, and then almost all the stocks are reached the 10% daily maximum increase after hours after the opening of the market. And that's why the morning trading activities are so high, but there's pretty much no activity in the afternoon. So the second principal components successfully pick out this trend. So, and lastly, it's the correlation. So if we look at the correlation structure at the account level, so this is the first principal components. So selling and buying, those are the overall selling and buying activities. The correlation is very high. So which means people who sells more also buys more, right? And which makes sense because on the stock markets, that the majority of people, when they sell stocks, they're not just putting the money into the bank. What they did is, I'm gonna sell this stock, I'm gonna buy some other stocks, so to rebalance my portfolio. So if they do this, and it's very likely that when they sell more, they also buy something at the same time. So there is this is why the correlation is so high. But if you look at the second one is the afternoon trading activities. That means when people tend to buy something in the afternoon, it doesn't mean they will also sell that in the afternoon. They are more likely to sell. Well, there are some correlations, but many people also like to sell in the morning. So there is some sort of a delaying effect at the second level, so this is an intraday feature we capture in addition to the overall trading and trading activities. So I think I should stop here. Now there are some extensions I want to say. So since we have a kernel estimators, so we need to pick out the bandwidth, and I don't have time to get to that issue because it's pretty technical. And we also develop a goodness of fit, not a test, but the diagnostic tools at different level to evaluate whether the model fits the data well. And sometimes we also want to model more complicated things. For example, in our stock example, one thing we can do is that the branches are located in different areas of China. And you know, the China are a very diverse country geographically wise, right? And then we're wondering whether there is any spatial clustering effects for different accounts, meaning that people in certain regions tend to trading at the same pattern. For example, people might trade stocks at a different pattern in the east coast of China from the people from the west part of the China, right? It's a bit because of their different socioeconomic status. So this kind of can also be modeled, and I just want to refer you guys to our paper if you are interested in more details. And that's the end of my talk.
Okay, thanks, Gangang, for the talk. Does anyone have any questions? Feel free to go ahead. Okay, is there any questions for any of the previous speakers?
Yeah, for Gangang, I'm wondering if the data are probably quite skewed for this type of data. The distribution of, for example, the trading activities, they generally tend to be more skewed than being symmetric.
We actually don't have a distribution because we don't have a response variables. All we have are the trading times. And if you're talking about the distribution of the trading times, yes, it's very uneven throughout the day. So it's more likely to be both end of the day than in the middle of the day.
Okay.
Is the data public available?
No.
I see.
But it's available. We have it. If you're interested, we can talk.
I see. Have you tried to apply this method on the stock market in US?
No, that's not my research interest.
I see. Okay.
So when it's done, it's done.
Any other questions? Any questions for Gangang or for Ying or Zhengling? Well, if not, let's thank our speakers again, please. Okay, thank you very much. And also thanks everybody for coming to this session. And thank you for participating in the conference. I guess we can end here. So I wish everybody a very happy afternoon.